For decades, corporate finance operated on a simple assumption. If you hold more than 50% of a company's voting shares, you control that company. Let's test that baseline scenario. A parent company holds 51% of subsidiary A and 0% of special purpose vehicle B. Under IFRS 10, the parent might be required to completely exclude the 51% subsidiary while fully pulling the 0% SPV onto its balance sheet. This occurs because IFRS 10 demands that financial reporting reflect the underlying economic substance of an arrangement rather than its superficial legal form. Relying solely on a shareholding register to define an organization is an obsolete metric. Legal ownership is merely a single data point, and frequently it fails to reveal who is actually directing the business. Getting this wrong leads to catastrophic misrepresentations. A flawed control conclusion distorts a firm's true scale, hides highly leveraged debt in unconsolidated vehicles, and gives regulators and investors a false picture of the parent's actual risk exposure. To fix this, IFRS 10 focuses on defining the consolidation boundary. This is the strict reporting perimeter that dictates exactly which assets, liabilities, income, and cash flows legally enter the parent's financial statements. Inside this boundary, the group must present itself as a single economic entity. That means mechanically eliminating internal transactions, removing duplicated assets, and wiping out any unrealized profits generated by entities trading with each other. If that boundary is drawn incorrectly, the financial statements collapse. A parent could artificially inflate its revenue by reporting sales made to itself, or shield its balance sheet from toxic liabilities it is legally obligated to cover. The standard solves this by deploying a unified, three-pillar control model. This model tests for power, variable returns, and the link between the two, applying identical logic across ordinary corporate groups, trusts, and complex investment funds. Locating the true consolidation boundary requires abandoning simple percentage thresholds entirely. Instead, management must perform a rigorous audit of who actually holds decision-making authority over the enterprise. The first pillar of the model is power over the investee. Under the standard, power is not an abstract title or a future possibility. It is defined strictly as the current, existing ability to direct the operations of the entity right now. But power only matters if it is pointed at the right target. The standard requires the investor to have authority over the relevant activities, the specific actions that materially affect the investee's economic returns. In a standard manufacturing company, identifying these activities is straightforward. The relevant activities are capital expenditure approvals, pricing strategies, and product development decisions. In a highly structured financial vehicle, the operations look completely different. The relevant activities might consist entirely of asset selection, managing defaulted receivables, or executing collateral enforcement. Crucially, the authority to execute these activities can exist entirely outside of voting shares. Power frequently resides hidden within management contracts, call options, or specialized shareholder agreements. To prove the first pillar, auditors must strip away administrative trivialities and pinpoint exactly who holds the steering wheel for the specific decisions that generate revenue or risk. Cautionary tone. Simply possessing a legal right in a contract does not automatically grant operational power. IFRS 10 requires rights to be substantive, meaning the practical ability to exercise it when a decision is required. Options lack substance if blocked by extreme prices, tight timing constraints, or the cost of uniting widely dispersed shareholders. If a right fails the substance test, it often falls into the opposing category, protective rights. Protective rights include terms like a lender's loan covenant or a minority shareholder's veto over extraordinary asset sales. These clauses are designed exclusively to safeguard an investor's interest against fundamental structural changes. They do not grant the holder the authority to govern day-to-day operations or direct relevant activities. Confusing a protective shield with a substantive steering wheel is a primary cause of failed IFRS 10 audits. Protecting downside risk does not equal operational control. The second pillar requires the investor to have exposure or rights to variable returns from their involvement with the investee. The narrow assumption here is to look exclusively at formal distributions, like equity dividends. IFRS 10 completely rejects that limitation.
Returns are defined broadly, capturing management fees, tax benefits, and strategic access to scarce resources. It also captures the negative side. Absorbing downside risk through credit exposure or issuing guarantees is equally critical. Even a legally fixed payment, like a set servicing fee, is classified as a variable return if the likelihood of actually receiving that payment is exposed to the underlying credit or performance risk of the investee. If an investor's overall economic fortunes fluctuate in tandem with the performance of the investee, the threshold for variable returns is met. The third and final pillar is the link. Possessing power and variable returns independently is insufficient. The investor must have the ability to use its power to directly affect the amount of its own returns. This creates a severe complication in structures involving delegated power. Asset managers, general partners, and trustees routinely hold sweeping operational power while receiving variable returns, blurring the line of true control. To resolve this, the standard requires a specific test. We must determine if the decision maker is acting as a principal or an agent. This flowchart resolves the ambiguity. Node 1 examines the scope of authority. Node 2 tests removal rates. Firing without cause defines an agent. Node 3 evaluates if remuneration is disproportionate, while Node 4 checks if subordinated co-investments push them toward principal status. An agent merely executes a service on behalf of others. A principal leverages its delegated authority to directly drive its own economic enrichment, legally requiring them to consolidate the entity. We apply this framework to our opening paradox, a parent holding 51% of sub A and 0% of SPVB. Let's deconstruct subsidiary A. A shareholder agreement reveals a minority investor holds a substantive right to approve all operating budgets and capital expenditures. Because of this substantive right, the parent fails Pillar 1. Despite holding 51% of the voting shares, it lacks the power to direct relevant activities. It must deconsolidate the subsidiary. Now look at SPVB. The parent holds zero equity, but it executes a management contract with broad authority over the vehicle's assets, and it absorbs first loss credit risk. That combination perfectly maps to the principal outcome on our flowchart. The parent has power, broad exposure to variable returns, and the ability to use its authority to enrich itself, fulfilling all three pillars. Applying the IFRS 10 framework strips away the illusion of legal form, ensuring the final consolidation boundary perfectly aligns with the enterprise's true economic reality. In practice, applying this standard demands rigorous evidence gathering from corporate finance teams and external auditors. Control conclusions are universally classified as high judgment areas. They are heavily scrutinized because management teams frequently face powerful incentives to keep debt off the books or inflate their operational scale. Proving control requires cross-departmental documentation. A share register is useless without the accompanying signed shareholder agreements, option schedules, debt covenants, and management mandates. Furthermore, this assessment is continuous. Control is dynamic. It can be lost or gained mid-year due to contract expirations, exercised options, or triggered default events. IFRS 10 is not a mechanical checklist. It is an analytical framework that demands constant vigilance, ensuring that a firm's financial statements accurately communicate exactly who holds true economic command.